So today's topic is options. Options, it means how options looks like in system, how funds or even traders they make the money from the options, and key terms about options like premium or in the money, out the money, and at the money terms, how that works while trading in the options and all. So we're going to cover all that important terms. So I would say here you can, learn all key terms, but before that, I need commitment from you guys. Once you go through this session, I would like that you have subscribed to this channel, like it, and share this content with others as well. Because what I want, like, I'm here to provide you insightful information, but if you don't share this information with others, then see, that doesn't make any sense. I'm investing my time, efforts, and everything, so I would expect the great cooperation and coordination. So let's start it with this. So here, if you see, first of all, question would be, can we see option trades with stocks? Yes, we can see option trades with stocks as well as indices. So if you see here, so this one is indices, Nifty is indices, Bank Nifty is indices, and apart from that, you would see many other indices as well. But for example, we'll discuss about only, Bank Nifty indices, how Bank Nifty works, indices works, and how you can enter into option contracts of Bank Nifty. And here you can also understand the in the money, out the money, and also at the money term as well. So now if you see, you have a live data. First of all, indices, it means Bank Nifty represent the group of banks. Group of banks. If you see, let's say HDFC, if HDFC price goes down in the market, then ultimately the price of indices also will go down. And go and check it today, the price of most of the banks is down. So I'll show you after this, means at the end of the session, so that you can relate, right? So it means, and if you want, again, if you want to relate that, how the bank prices works, go and check the NSE option chain analysis. Here you can check the price of contracts. Go and check the Bank Nifty. Bank Nifty, price of all the banks. See this. Most of the banks or their prices. Here, most of the banks, it means Axis, Bandhan, SBI, Kotak, HDFC, Bank of Baroda, IndusInd, PNB, AU Bank, they represent the indices. So total of all this points, it will tie with the Bank Nifty points. So now means today, so most of the banks, they are down. And if you want to relate, so major bank contributor is Kotak, HDFC, right? And then IndusInd. And apart from that, SBI, I don't see much of contribution, but these are the three big banks. If the three big banks, they are down, here if you see, by around 40 rupees down, so it means ultimately you would see big change in the indices as well. So ultimate point here is, so indices, Bank Nifty represent the appreciation and depreciation of the banks which are included in the indices. Now I hope you got the idea about how the indices works. So it means indices represent to the stocks of different banks which are included in that particular stock, right? So now, so I'll take you to the screen of this, how you can enter in the option trades. See, first of all, you need to open the trading account with broker. Once you open the trading account with broker, so you can select the options. So here, if you see this one, 405, this become your strike price. This become your what? Strike price. So what exactly strike price it means? Strike price. Understand this, strike price, it means price which you feel that as a trader, you feel that price of particular options maybe go down the 45,000. Why say you feel that? The reason is current market price. If you see this current market price, it means this 44,992. So this is the current market price of Bank Nifty. But if you see today, the Bank Nifty is down by around 350 points. So ultimately, if I target to this price and if I enter in the particular Bank Nifty contract, so that becomes at the moment. So if you relate this one, this is becomes strike price and Bank Nifty both are in a line. So that becomes your ATM at the money. So it means current market price of that particular indices and the price which you are targeting. So if those means input, like let's say Bank Nifty and your contract price, if both are in line, so that becomes your ATM at the money, right? At the money. So same example that you can put it down or write it down if you want. At the money, it means indices price and the contract price, if both are in a line, see 8 point 10 point difference, that is still okay. But at the moment, if you see 8 499, so it means in this way you can say it's in the money. Then why in the money, sir? The reason is this price is above the current market price. So now current market price is down. Current market price is down. So in that case, this put option becomes your in the money. And when this put option become in the money, what happened? I'll show you the trailer. If this put option, this price put option become in the money, then if you see, I have around realized profit of 3,680 rupees. I have a profit of, this is the profit. So how did I earn this profit? Because I purchased this option at 227 around and sell at 306, right? Sell at 306. So I made a profit of 3,680. So it means if your option turn into the in the money, any or out the money, because before this, let me tell you the story. Before this, it was, I'll tell you, I'll show you the data so that you can relate how in the money and out the money works. So here, go to the place order, go to the my portfolio, then place order, not place order, open position or order book. Yeah, here. If you see, the important aspect to understand is buy price. We have buy price, which is 226.04. This is the buy price. Here, if you see, sell price of option is 300, right? So I made a profit of around 3,680. Quantities which I purchased 50, if you see here. But the important aspect to understand is when I purchase this, market price of options was at the moment 45,100. Means current market price was this, and then I purchased the options of 45,000 P put options. And when the automatically means price went down, this current market price went down. Now if you still see, this current market price went down, and that's how ultimately I could make a profit from this contract. So it means if you purchase any option as such, and if that, because before this it was out the money, it was OTM, right? Before this it was OTM, out the money. And when I made a profit from this, so that out the money options turn into in the money, and then I made a profit for me. Right? Still, if you see here, now at this moment, current market price, which is current market price 45,010. So this option becomes ultimately OTM, out the money. The reason is strike price is 45 and current market price is more than 45,000. And if you see this here, if the option becomes out the money, then ultimately price of the options that will go down, means premium will reduce automatically. So see this movement. Now here, see this price 45,000. So this option is become now out the money. OTM. Why OTM? So you can relate it because your strike price is 45,000, but the current market price is more than 45,000. If this price goes beyond that again, then ultimately you would see impact on premium. Premium, it means premium will reduce or premium will down automatically. See this here. If the market price goes high, then ultimately here if you see your premium will ultimately it will reduce, right? So that's how you can relate in the money, out the money, and in the money, out the money, and at the money. At the money, it means your option strike prices and your current market price. If the both are same, so then you can say it's a at the money option. If let's say your strike price is let's say 45,000 and current market price is more than 45,000, so that becomes out the money, right? And let's say in the money, it means strike price is 45, but the bank nifty current market price is let's say below the 45,000, below the 45. So it means from this price, if the below the 45,000, so then that option becomes in the money for you. And now let's say if you enter in this option, once you enter in this option and hold, and let's say if you are lucky and then this price goes down, then ultimately you can make a profit from this contract. So now if you see when the in the money, see now in this condition, now you can say it's in the money and see the impact on premium as well. So see this, it was 282 when it was out the money, but now if you see ultimately this option, now relate that this option becomes in the money now, in the money. And when this option becomes in the money, ultimately if you see price reached to at 300, so it means 300 points, sorry, around 282. So it was 282 when this option was out the money, 282 to 300. See this, around 20 points profit that you can see here. So this is the difference, guys. So that's how you can see when your options, which is in the line, so it means you can make more profit. And when your options, let's say you have out the money, so it means you cannot make the money. See this movement. So it means it's a highly volatile. And apart from this, if you're looking for a trading from a trading aspects and all, let me clarify a few things. So from entry perspective, so you might see question like, what if your option is in loss? Let's say you purchase option at 300 for per unit. If you purchase this at 300 for per unit, what if you lost everything? So your maximum profit would be this. Your maximum loss would be this, right? So that's how you can relate. So you might expect questions from the entry perspective. So your maximum loss would be your premium which you're gonna pay. Apart from that, might broker can charge additional charges. That is something different. But from this contract, you might expect maximum loss is 300 for per unit, right? Around 6,000 for per this contract. So if I, let's say if I invest this, so I might see maximum loss of this. And what would be my maximum profit then? Maximum profit is based on the current market situation. If the market, let's say, what if this indices goes down by 1,000 points? So you means as an option holder, you will get around 1,000 points or 2,000 points. So see this means that depends on the market. So in short, I can say unlimited profit, limited loss, unlimited profit. And same options option writer will write this. So maximum option writer can earn 300 points. Maximum. But loss for option writer would be unlimited. Loss of option writer would be maximum. So what is the difference between option holder and option writer? Option holder, it means option buyer, we can call it as option holder, and option writer, it means same option, put option, option holder, sorry, option writer can write this. So it means short sell this. And if short sell this, that becomes option writer. That's the difference, right? See this, guys, 320 in the money. Why in the money? Because this option becomes in the money, and when option becomes in the money, it becomes more volatile. See this. That's how you can relate it. When your option turns into out in the money, you can make more profit. So when we checked it, it was 282 to 320. So it means almost within 5 minutes, the movement is around 50 points. See, so that's how you can relate about options and all. Options are risky. If you don't have a knowledge, then you don't need to enter anything in option contract as such. Okay, from a fund accounting perspective, we book the options with IDs. This is become your option IDs, right? And this data. So we update the options with trade date and settlement date, and we update it, right? So it means derivatives team, they will take care of it and update the options in the books of fund accordingly. Apart from this, here the key information that you need to check. PE means put European. E means European. There are 3 types of options. One is European options, another one is American option, and apart from this, there is one more option which is Bermudian, which offer the features of European and American. That options you can call it as a Bermudian option. But the important aspect is again to understand. So here if you see weekly expiry, so it means stock exchange will expire the contracts on a weekly basis. But if I take the example of American options that will not have a weekly expiry. So you can exercise that option at any point in time. So that would be depends on you. So you can means at any point in time you can exercise that option. See this, guys, within 10 minutes profit is 30 or 20, 50 point profit. See, option reached at 50. When the option becomes you in the money, then ultimately you can make more profit. So now I hope that you understood in the money and out the money. So market price and strike price. Now strike price is 45,000 and market price is 44,900. So it means this option becomes in the money. And when you purchase any in the money options, you would see more volatile. The chances of profit making would be higher. So that depends. You can make more money as well. I have means here from this contract within 5 minutes, I could make around 4,000, right? Okay, so we'll take one example for out the money. Out the money, it means live. So how it looks like to see out the money, it means what exactly. So I'll purchase one option for you. So if you see this one, market price is 44,900. Okay. All right. So what I'll do, I'll purchase one option so that you can understand it, how the option looks like. Go to my watch list. Again, option contracts. Here you can select Bank Nifty. As I told, we'll look about Bank Nifty only. So these are the options. Current market price which seems 494, right? But here if you see, if I see the chart, I don't see any possibility of market, positive trend for today. But still, if I want, let's say what I can do, I'll purchase this quickly for you. I just want to walk you through. Here, if you can see, there are 2 categories. One is call and another one is put. So what I'll do, I'll buy the put option. So, but how we can relate that, whether it is in the money or out the money? current market price, if you see, current market price of the contract is 44,950. If I purchase this one as a call option, that becomes out the money for me. So I'll purchase the out the money. Let's say this one I'll purchase it. 44. I'll purchase this quickly. And see, price is, select the price. Let's say I'll buy quickly. And we'll wait for execution of the trade. So now if you see, if the trades get executed, so that becomes out the money for me. The reason is current market price is 44,960. And here, if you see, strike price which I purchased at this one, 45,000. So let's see, we'll go and check the details. What happened with that? Options, select here, come here, open position. Yes, the trades get executed. Now we have a loss of 35.68. So see why we have a loss. You can relate that. Why we have a loss? Just because we have a loss because see, 45,000, it's a CE. See, it means call option. When we say CE, it's a call. CE means call, European. We have a different types of options, call European and put European. This is a call European, right? Call means buy. I have buy this. Sir, why you have purchased this? I'm expecting the reversal of price. Reversal of price up to 45,000, right? I'm expecting reversal of price up to 45,000. So that's what I have purchased it. But if you see in market price of the option is something different. Means, sorry, Bank Nifty is 44,933. Now, so I'm in a profit of 65,150. So you have this data. So now you can relate. I just want to walk you through the live examples. That's what we are here to discuss about live example. How market price affect on your options. See this. Profit of 180, 200. See, if the current market price, spot price, current market is, it means your spot price. If the spot price goes high, ultimately, I'll be in profit. The reason is it is a call option and I have expectations. Price, it will reach to this. Price will goes high. I'm expecting that, right? Price will reach to the 45,000 and that's what I have purchased it. So my prediction might be go wrong. See, I'm not a Chanakya of this market. It is just for a training purpose. I just purchased quickly so I can walk you through how out the money, in the money, it looks like. Right? So see this. This is the your strike price. Strike price. And this is my current market price of the indices. If the current market price goes high, so this call option which will offer me profit. So this call option would be in profit. And if this, let's say, current market price goes down, then this option provide me losses. So that depends, right? So now we are just waiting to see what is the exact situation. We'll wait for 2 minutes to observe this, what happened. If this option within a 2 minutes, if cross the 45,000, then we would be in a profit of around 1,000. But let's see what happened. So I'm expecting it will reach. If not, then we'll again. So that depends. If price goes beyond the 44,900, means below the 44,900, then we'll incur loss as well. So that's fine. This is just for a training purpose, right? I just want make you guys understand how strike price and current market price looks like, and that the difference of that current market price and the your strike price, then you can put the your in the money and out the money, because this call option is out the money for me at the moment. If this turn into the in the money, then ultimately I'll make profit. So that depends exactly what happened. Let's see now. If you see again, we have a loss of 90. I'm waiting. If this turn into in the money, then I'll make profit. So I'm waiting for it. So what would happen with this? Anyways, apart from this, meanwhile, we'll discuss about few important terms. Guys, don't hold any options. If you have any, let's say, any highly classified information that the market will go down or market will go up, in that case, you can hold the options, because options, if you hold any options, so it means you will be penalized. You will be penalized in a way, you will get the penalty, and that penalty will adjust in your options. And that's what, so we have option Greeks. Greeks, it means theta, vega, uh, then your beta, volatility, right? So, and time, even time is important for option holders. So if you hold the options in a overnight, ultimately that will affect on the volatility, that will affect on the price, beta and everything. And ultimately that you will lose, money in this particular contracts. So I would not recommend to hold any option contracts as such. You don't need to hold any for overnight. If you can buy it and sell it if you want, for same day, if you have any news in hand, you can. But ultimately what happened, even if you hold, try to hold try to hold in the money options. But I do not suggest that to hold any options. If you hold it, ultimately you will end up with the losses, because you will get penalized in terms of time. The premium of this is a premium, it means the price which you paid. Premium works with time. So understand, in a way, premium, it means it's a lifeline of options. And let's assume this option has a lifeline of 7 days. Lifeline of 7 days. This option has a lifeline of 7 days. What if already 2 days gone, 3 days gone, 4 days gone? So it means on 7 days, this option will die. This option will automatically die. So that's what you need to understand the logic. If this option has a lifeline of 7 days, why you're holding them? You don't need to hold any option as such. Don't hold any options, because this 7 days include your day and night both. Day and night both. If option days or if night has gone, then ultimately that will affect on the premium which you have paid. That premium will reduce automatically and it will incur with the losses. So I would not recommend to hold any options. And if you see any questions as such in the interview as well, so you can say it, option has a Greeks. So it means those are the valuation methods which help you to calculate the exact value of options. And on the basis of that, you can take the decisions whether you want to hold these options or not. You shouldn't hold any options. And one more important point, this is not for an interview perspective, but this is just for a good to know. Most of the people, they lose 90% money in out the money options. Why out the money options? Because 250 rupees, what they believe to pay 250 60 rupees for a per quantity, that becomes costly. So why should I pay 40? Let's say why should I pay 10,000, 20,000, let's say 50,000 for this particular contract? So I'll not pay it. Might be that you don't have a money and you're trying to buy the options with 5,000, 6,000. So you'll always look for out the money, and that's the reason you guys end up with the losses. So it means you will have to bear losses ultimately. Out the money options, 98 times they'll offer you losses, only 2% times so you might get profit. And that's the reason I would say, if you are a trader, so, or if you are in a intention of if you want to refer this session as a trading purpose, I would request you guys, please do not enter in any out the money option contracts if you don't have a right strategy, because most of the out the money contracts, those would be on a radar of big sharks or big writers, where they write the options, they easily write the options and make the money. So I would not recommend that, because most of the people they recommend and they end up with the losses. So you don't need to buy any kind of option as such, out the money option as such, which will incur or provide you losses, right? So again, here we are here with the loss of 95 rupees. So let's see what happened. I'll hold this. So you can refer this for education purpose or training purpose. So don't replicate that while trading as well. Don't do this. I just want to make you guys to understand how in the money and out the money looks like in a live market, right? So I believe that you got this idea options how it works. So few technical questions around that you might expect. Option contracts hold the weekly expiry. So if you see this here, every week this option contracts will expire. For option contracts, you need to pay the premium. Premium, it means if you want to buy any option contracts, you will have to pay the premium. How's the premium looks like? So I'll show you that. Let's say if you want to buy, go to the here option. So here actually they call margin, but it is in a option terms, it is a premium. Click on any option. Let's say this one. Here if you see, it required margin. Margin, it means it's a premium for you in option. So you can select limit or limit price. It means buyers put that price, select that price. Market price can be different and buyer price quotation can be different. Market price, it means it's actual market price. Always try to buy the options or any securities as such at a limit price, not the market price. When you select the market price, broker will try to execute the trades at a market price. It means always put a logic. Buyer will try to buy the assets at lower, but seller will try to sell the assets at higher price. So it means you will get the higher price if you're a buyer, right? So don't do that. Always select limit price. If you want to put a stop loss, you can put a stop loss. If you don't want to put a stop loss, then don't put a stop loss. So see whether you want to put or not. So that's your call. But how the option looks like, you can select any option and buy it. But while selecting options, so make sure that you have checked the market price. So now if you see here, if I buy this option, market price of the option is 19,381 and the price of this C means call option, strike price of the option is 19,400. So this becomes out the money options. And premium also that you would see now, which is low. But once the this price and this price come in same line, that becomes ATM at the money, and that is even also BEP. BEP means break even. Once the break that price, this price 400, ultimately you can make profit a lot from this as well. So that depends. This is the one aspect, means how you can buy, right? What about sell? So now understand this same option. If I write this, so here if you see the margin is required, so it means premium is required. What if I want to, let's say, write this option, what will change? We'll see that. Same option 400, same option 400, call option. Instead buy, if I want to sell it. If I want to sell it, then I'll have to pay entire margin. Okay. So previously we already said that. You see the price, it means premium. If I want to buy it, see margin required. If I buy it normally, the margin is required 4,700 only. But if I sell, if I want to sell it means writing. Again, same option. If I sell, instead buying, if I sell, that becomes option writing. And for option writing, if you see, you will have to pay entire amount. 1 lakh, sorry, 11 lakh it goes around, I believe. 1,11,000. Okay, 1,11,000 1000 amount that will have to pay for a 50 quantities. If I write this option, if I write this option, and what if I want to buy this option, if I want to buy this, click on buy, I need to only pay 4000. So it means option writer is investing more amount than option holder. And if the option writer is investing more amount than the option holder, so it means option holder chances are high to make a money, because option holder is investing lakhs of rupees in one option to make the money. And if you see, put a logic, if you hold the option holder is investing 4,000, and the chances of money to earn is 1,11,000. So maximum profit option holder can make is 1,11,000. And option writer's total profit would be 4,700, and maximum loss would be 1 lakh. So it means higher the risk, higher the chances of profit. Option holder is the higher, risk taker. So it means option holder will make the high money. Sorry, writer will make the high money. And that's what I would say. You don't need to hold any options as such, right? So I believe that you got the idea about how this market means option market or market transaction works and all, right? And apart from the this particular topic, I would quickly walk you through about how you can apply the accounting treatment to this. So now if you see, I have a loss of 200 rupees. I can see loss of 200 rupees here. So total profit that I have, so 3,400. Total means already I make a profit of 3,600. But I purchased the option for you so that I can walk you through. Means you guys can understand this. So I have a two options, total of two. So which is 3,400 total realized profit that I have, right? So total profit that I have. So see this here, 3,450. So this profit that you can apply as an unrealized profit from the contracts. So you can prepare the accounting entry. If I have a profit, then option contract account debit to option contract gain on option contract account credit, and you can update this amount, so that becomes your accounting as well. So in that way you can relate and enhance your knowledge. So I hope you got the idea about how option contract works and all, what are the key terms and all, right? So still, if you have any questions, you can try to post your thought in the comment section, so I'll review it. And if you guys are expecting any session on any of this specific topic, so provide that. I'll try to provide you insightful information on that topic as well. And if you like this session, I would say please share this information to others. यार फ्री में भी मत देखा करो, एक लाइक भी नहीं करते हो या फिर शेयर भी नहीं करते हो, सो व्हाट मेक सेंस. सो आप लाइक करिए, आप शेयर करिए दिस इन्फॉर्मेशन, एंड मेरे यूट्यूब चैनल को भी ग्रो करिए, बिकॉज इतनी सारी इंसाइटफुल इन्फॉर्मेशन मिलती है, तो आपको ये भी देखना है कि फ्री में नहीं लेना है, तो उसके बदले में कुछ ना कुछ देना है. ओके, सो विल सी यू इन नेक्स्ट सेशन. थैंक यू and enjoy your day. We'll upload this session across all. Thank you.